Hi, this is Digital Wealth Code, where we break down the stock market, global trends, and long-term investing ideas. One of the most common questions new investors ask is this: should I invest in ETFs or individual stocks? It's a simple question. But the answer depends on how you think, how much time you have, and how much risk you're comfortable with. In this video, we're breaking it all down. ETFs versus individual stocks. In simple terms. Before we start, quick disclaimer. This video is for educational and informational purposes only. I'm not a financial advisor, and this is not financial advice. Always do your own research before making any investment decisions. Let's begin. First, what is an ETF? ETF stands for Exchange Traded Fund. An ETF is a collection of many investments bundled together. When you buy one ETF, you're buying exposure to dozens, hundreds, or even thousands of companies. Some ETFs track entire markets. Others track sectors, industries, or themes. Think of ETFs as a basket. Instead of picking one apple, you buy the whole fruit basket. Now, what is an individual stock? An individual stock is ownership in one company. When you buy a stock, you're betting on that specific business. Its growth, its management, its future. If the company does well, your investment can grow significantly. If it struggles, your investment can fall. Now let's talk about risk. Risk is the biggest difference between ETFs and individual stocks. With ETFs, risk is spread out. If one company inside the ETF performs poorly, others can balance it out. This reduces volatility. With individual stocks, risk is concentrated. One bad earnings report, one scandal, one change in the industry, and the stock can drop sharply. For beginners, managing concentrated risk can be difficult emotionally. This is why ETFs are often considered lower risk. Now let's talk about time commitment. Investing in individual stocks takes time. You need to research companies, understand their business model, read earnings reports, follow industry trends, and stay updated as things change. ETFs require far less effort. Most ETFs follow an index or a strategy. You don't need to constantly monitor individual companies. For beginners with limited time, ETFs are often the simpler option. Now let's talk about long-term versus short-term thinking. ETFs are designed for long-term investing. They benefit from overall market growth. They reward patience and consistency. Individual stocks can work long-term too, but they're often used for short-term ideas. Growth plays, turnarounds, trends. Short-term investing requires emotional control. Prices move fast. News matters more. Mistakes are amplified. Most beginners underestimate how hard this is. Now let's talk about returns. Yes, individual stocks can outperform ETFs. Some stocks grow faster than the market. But many don't. For every big winner, there are stocks that underperform or fail completely. ETFs aim for average market returns. Not spectacular wins. But average, over long periods, can be very powerful. Especially when combined with consistency and time. Now let's talk about fees. ETFs charge fees. These are called expense ratios. They're usually small, but they add up over time. Individual stocks don't have management fees. But frequent trading can increase costs through commissions and taxes. Long-term ETF investors often benefit from lower overall costs. Now let's talk about control. With individual stocks, you have full control. You choose exactly what you own. With ETFs, you accept the basket. You can't remove individual companies. This lack of control can bother some investors. But for beginners, less control often means fewer mistakes. Now let's answer the big question. What's better for beginners? For most new investors, ETFs are the better starting point. They offer diversification, lower risk, and simplicity. They allow you to learn the market without taking unnecessary risks. Individual stocks can be added later. Once you understand your risk tolerance. Once you understand how markets move. Once emotions are under control. Many successful investors use both. ETFs as a foundation. Stocks as a supplement. This creates balance. Growth opportunities without excessive risk. Here's the simple takeaway. ETFs are about consistency. Stocks are about conviction. ETFs reward patience. Stocks reward research and discipline. As a beginner, your goal isn't to be exciting. Your goal is to stay invested long enough for compounding to work. And simplicity often wins. If you found this video helpful, make sure to like and subscribe. This is Digital Wealth Code, and I'll see you in the next one.